$12,000 a year. That's the brand new tax deduction sitting in plain sight for retired couples right now. And the Roth conversion deadline everyone spent years panicking about? It never happened. In the next 15 minutes, you'll know exactly how to use this deduction to move IRA money into a Roth at some of the cheapest rates you may ever see. Get it wrong, and you either waste a window worth up to $48,000 in deductions, or trip a hidden clawback that quietly pushes your real tax rate to almost 25%. Here's the story. Congress made today's tax rates permanent in 2025, so the old convert before rates go up countdown is dead. But the very same law quietly opened a new window with a real expiration date. A bonus deduction of $6,000 for every person 65 and older, $12,000 for a couple, every year from 2025 through 2028. Then it's gone. Add up the years, and that's up to $48,000 of income the IRS never touches, but only for people who know the rules. Let's decode it. Chapter 1. The Window. The 2025 tax law, the One Big Beautiful Bill Act, created something genuinely new, a bonus deduction just for being 65 or older. Here's the rule plainly. If you are 65 or older by December 31st of the tax year, you get an extra $6,000 deduction. If you're married and both spouses are 65 or older, that's $12,000. But you must file jointly to claim it. It runs for tax years 2025 through 2028, and then it sunsets. The amount is frozen, the same $6,000 each year, with no inflation adjustment. And here's the part even many accountants miss. It's tax. It does not replace your standard deduction. It does not replace the existing extra deduction seniors already get. It sits on top of both. It even works if you itemize, which the old age 65 add-on never did. Now, let's stack the numbers for 2026, because this is where it gets impressive. Take a married couple, both 65 or older, filing jointly. Start with the regular standard deduction, $32,200. Add the existing age 65 extra deduction, $1,650 each, so $3,300. Now add the new bonus, $12,000. Total deductions, $47,500. Let that land. In 2026, a retired couple 65 and up can have $47,500 of ordinary income and pay zero federal income tax on it. A single filer 65 or older gets a smaller version, $16,100 plus $2,050 plus $6,000, $24,150 fully shielded. Those numbers come straight from the IRS's official 2026 inflation adjustments. This is not a loophole, and it's not a gray area. It is the printed table. The question is what you do with that much tax-free room, which brings us to Roth conversions. Why does a deduction matter for Roth conversions? Because of how a conversion is taxed. When you convert, you move money from your tax-deferred bucket, the traditional IRA or 401k, into your Roth bucket, and the amount you move is taxed as ordinary income that year. Ordinary income is exactly what deductions erase. So every dollar of unused deduction room is a dollar you can convert at an effective federal rate of 0. The new bonus means a qualifying couple has $6,000 per spouse, $12,000 total. More of that room every year through 2028 on top of everything else. And this is genuinely use it or lose it. Deduction room does not roll forward. The 2025 slice is already behind us. As I record this, you have 3 tax years left, 2026, 2027, and 2028. After that, the bonus is gone and the window closes for good. So, is it free money? Almost. There's a catch. Chapter 2. The catch. This deduction has an income limit, and it's aggressive. The phase-out starts at $75,000 of modified adjusted gross income for a single filer and $150,000 for a married couple. For most retirees, that income number is essentially your adjusted gross income, the line that includes every dollar you convert. Above the line, the math works like this. Each qualifying person's $6,000 shrinks by 6 cents for every dollar of income over the threshold. Both spouses qualify. Both deductions shrink at the same time, so the household loses 12 cents per dollar. Run it out, and the deduction hits zero at $175,000 for a single filer and $250,000 for a couple. The research team at kitches.com worked a clean example. A couple at $200,000 of income is $50,000 over the line. Each spouse's deduction gets cut by $3,000, half, leaving $6,000 total. Halfway across the phase-out zone, half the deduction is gone. Now, connect that to conversions, because this is where retirees will get hurt over the next 3 years. A Roth conversion raises your income dollar for dollar. So if a conversion pushes a qualifying couple past $150,000, every additional dollar gets taxed twice over. Once at your regular rate, say the 22% bracket, and again through the clawback, as 12 cents of deduction disappears per dollar converted. 12 cents of vanishing deduction taxed at 22% adds about 2.6 points to your real rate. Inside that phase-out zone, your true marginal rate is roughly 24.6%, making almost 25 cents on the dollar dressed up to look like 22. One example? Making the rounds among planning firms. A conversion of $100,000 that lifts a couple from $150,000 to $250,000 wipes out the entire $12,000 deduction. Roughly $2,800 of extra tax stacked on top of the normal conversion bill. The fix is not to avoid converting. The fix is to know exactly where the line is and convert up to it, not through it. Chapter 3, The Math. Let's make this real. Meet Tom and Linda, a composite couple, but the numbers are real 20 to 26 numbers. Both are age 67. They have $800,000 in traditional IRAs, money that has never been taxed. They live on a pension plus interest and dividends, about $70,000 of adjusted gross income a year. They are deliberately waiting until age 70 to start Social Security, which makes these next few years their low-income valley. And there's a clock running. At age 73, required minimum distributions begin. The IRS will force money out of that $800,000 whether they want it or not. 6 years from now, the choice gets made for them. So, the question for 2026 is simple. How much of that IRA should Tom and Linda convert to a Roth this year without tripping the phase-out or any other line? Start with their deduction stack. Standard deduction plus the age add-ons plus the new bonus, the $47,500 we built earlier. Subtract that from $70,000 of income, and their taxable income is just $22,500, sitting near the top of the 10% bracket. Now look at the room above them. In 2026, the 12% bracket for a couple runs all the way up to $100,800 of taxable income. They're using barely a quarter of it. That leaves $78,300 of space, and that is their conversion number. Convert $78,300 and watch what happens on the ladder. The income climbs, fills the rest of the 10% rung, fills the entire 12% rung, and stops exactly at the top. And check the phase out. $70,000 of income plus the conversion lands them at $148,300, still under the 150 line. The full $12,000 bonus stays intact. Every box checked, by design, not by luck. So, what does this conversion actually cost? Build the math line by line. Before converting, the tax on $22,500 of taxable income is about $2,250. After converting, taxable income is $100,800. And the 2026 tax table puts that bill at $11,600. Subtract the two. The conversion itself costs $9,350. $9,350 to move $78,300 into an account that, under current law, is never taxed again. That's an effective rate of just under 12%. And notice what the senior bonus did inside that math. Without the $12,000 deduction, the last slice of income would have spilled into the 22% zone and cost an extra $2,640. The bonus deduction alone is worth $2,640 to Tom and Linda this year, and a similar amount in each remaining year of the window. Total, the picture. $78,300 moved for $9,350 at what may be the lowest rate this money will ever see. One more line to check, and it's the one most people forget: Medicare. Once you're on Medicare, your premiums are means tested through a system called IRMAA, and it runs on a 2-year delay. Your 2026 income sets your 2028 premiums. On the published 2026 table, the first cliff for a married couple sits at $218,000 of income. The thresholds drift upward with inflation each year, but that's the planning line we have today. And Medicare uses its own measure, adjusted gross income plus any tax-exempt interest. Cross that line by a single dollar, and each spouse on Medicare pays the surcharge. On today's numbers, about $81 more per month for Part B, plus another $14.50 for drug coverage. Call it $95.70 a month per person. For a couple, that's roughly $2,300 a year in extra premiums, triggered by $1 of overshoot. So where do Tom and Linda land? Their converted income is $148,300. The needle sits $69,700 below the first cliff. Comfortable? But notice how deliberate that is. A bigger conversion, say everything up to the $250 phase-out endpoint, would have blown straight past the Medicare cliff on the way. Now, compare all of that to doing nothing. Tom and Linda could skip the conversion and let the $800,000 ride. Assume a steady 6% return, and by age 73, that IRA is roughly $1.1 million. Then, required minimum distributions begin. Forced taxable withdrawals every single year, stacked on top of the 2 Social Security checks they switched on at 70. The low-income value is gone, the senior bonus deduction expired after 2028, and those forced withdrawals would come out at 22% or worse. The same $78,300 withdrawn at 22% cost over $17,000 in tax versus the $9,350 they'd pay to convert it today at age 67. That's nearly $8,000 saved on 1 year's move. Run the same play in 2027 and 2028, and Tom and Linda shift nearly $235,000 into the Roth and save on the order of $23,000. Money that, under current law, grows tax-free with no required withdrawals for the rest of their lives. Chapter 4. The Move. Here's the playbook, step by step. Step 1. Find your room. Take $150,000 if you're married filing jointly, $75,000 if you're single, and subtract your expected income for the year. That gap is your clean conversion budget before the deduction starts shrinking. Step 2. Fill from the bottom. Use your deduction room and the low rate zones first, the way Tom and Linda filled to the top of the 12% zone. Step 3. Check the premium cliff. Remember the 2-year delay? This year's conversion sets the premiums you'll pay 2 years from now, and the first cliff for a couple is $218,000. Step 4. If you're harvesting 0% capital gains, be careful. For a couple in 2026, the 0% rate on long-term gains runs out at $98,900 of taxable income, and conversion income stacks underneath your gains. Step 5. The fine print. You must file jointly to get the bonus. Each qualifying spouse's social security number goes on the return, and the conversion cannot be undone once it's done, so measure twice. And do it by December 31st. Conversions count in the calendar year you make them. So who is this actually for? Here's your decision map. If you have under $400,000 saved in tax-deferred accounts and your income sits comfortably below the thresholds, relax. The bonus deduction shows up for you automatically, and small conversions are cheap, but the stakes are modest either way. If you're holding $500,000 to $1.5 million in IRAs or 408 donkeys, and your household income sits anywhere near or below $150,000, you are the exact person this window was measured for. Run these numbers every single year through 2028, because the valley years before Social Security and forced withdrawals are when this math sinks. And if your income already clears $250,000, the bonus is fully phased out for you. And for households above $2 million saved, the conversion decision still matters, but it rides on rate zones and Medicare cliffs, not this window. This video is education, not personalized financial, tax, or investment advice. Your numbers are your own. If you want a free Roth conversion analysis built on your actual situation, go to GaryLifeIndex.com/Roth conversion.